Okay, good morning, everybody. Thank you, Philip, for organizing this conference. I'll start by following your example on the connection between the Hebrew language and the taxes. For the ones of you who know Hebrew, there is a phrase in Hebrew that says, Yarad letimyon. Someone ever thought what is timyon? Someone knows where is timyon that you have to go down to? Well, the timyon, exactly. Timyon is a Greek or Aramaic word for the government treasury. Meaning that Yarad letimyon, it's when to you pay taxes. It's the phrase of meaning useless. It's when you want to say something in Hebrew that is useless or completely useless, then you say it's Yarad letimyon. It's meaning it went to the government. So it's deep in the Jewish history that that the use of taxes is not always proper. So we'll now move to the recent developments in the Israeli taxation, and I'll start with, I think, which was the most significant one, and there was a real revolution here. It's the exchange of information, and there are a few big changes regarding exchange of information. I'll start by what's happening today. According to the existing law, tax authorities are obliged to confidentiality. They cannot provide information of taxpayers unless they are permitted by law. There is a specific section 234 of the Income Tax Ordinance that forbid the Israeli tax authorities from providing any information to anyone. There are a few exceptions for it. One of the exceptions is on criminal matters. On criminal matters, tax authorities can provide information to any country, even if there is no treaty with this country. So, for example, they can even provide, for example, there is no tax treaty with Australia, so on criminal matters, they can provide information to Australia as well. However, on non-criminal matters, tax authorities can provide information only under tax treaties. And the scope of the exchange of information under tax treaties, under Israel tax treaties, is quite limited. The current interpretation, and there was a question about it earlier today, the current interpretation, and I think it's also the position of the tax authorities, is that the current tax treaties of Israel do not allow for automatic exchange of information. So currently Israel do not provide automatic information to other countries. However, it receives information from other countries. There are some countries that provide the government of Israel with disks, with computer disks, which contain information about Israeli bank holders in these countries. No one knows who are these countries, so I cannot tell you. It's probably not Switzerland, but there are some European countries that provide information. There was once a case of a Danish account in Denmark that was caught in this way, so probably Denmark is one of the countries that provide the information. But there are a few others, and it's a secret. Tax authorities do not announce which country provides them with the information. In any event, Israel currently do not provide any automatic exchange of information. It needs to receive a specific application. For example, if the U.S. wish to obtain information about Israelis, it needs to submit an application, specific application. There cannot be a phishing application. For example, they cannot ask for all the U.S. Holders of real property in Israel. It's a phishing. They cannot do phishing. They should come with a specific name, and then they will, of course, get it under the limitation of the treaty. The most scary thing in the current process for exchange of information is that, in essence, the taxpayer is not involved. If there is an application to get information, no one tell you about it. The tax authority simply process the application. There is only one person in the international department that is responsible for it. He decides what to transfer and what not to transfer. The taxpayer is not notified, and he don't know that any information was asked about him, and he cannot object. So if this officer is doing a mistake, then the information simply goes, and no one can supervise it. It's only internal procedures of the government, but in essence, it is not properly supervised, and there are a lot of exchange of information currently. Now, the world is, as we'll say there before, the world is moving toward the automatic exchange of information, and during the last year, there were very, very significant steps in this direction. First, the OECD approved the standard model of treaty for automatic exchange of information. 2 weeks ago, 51 jurisdictions signed a treaty for automatic exchange of information. Israel is not there. US is not yet there. Also, Switzerland is not yet there. But all the countries that signed have committed to make automatic exchange of information as of September 2017. So it's almost there, and I believe that many more countries will join this treaty, and the automatic exchange of information will probably start in the next 2-3 years. Now, in order to be able to facilitate this agreement and to sign such an agreement, there should be a change of the legislation in Israel, because currently Israel cannot provide automatic exchange of information. It's not that the government cannot provide the information, it cannot currently obtain it from the bank. The tax authorities cannot come for a bank and tell him, give me the names of all your clients. It's impossible. Again, tax authorities cannot do phishing with the banks. They have to come with specific information. So currently there is no authority in Israel to do automatic exchange of information. And as a result, the government proposed a new bill. It's called Amendment 200 of the Income Tax Ordinance. And this bill will allow the government to sign treaties for automatic exchange of information. The bill was introduced to the Knesset at the end of January, but until now nothing happened with it. But probably it will happen in the next, currently everything is stuck with the budget law, but probably after that it will be approved and the government will start the process of signing the treaties for exchange of information. No one knows yet when it will be effective and whether current accounts will also be reported. We, on behalf of the bar, submitted comments to this legislation, and we asked that there will be some kind of waiver period for account holders that will have the opportunity to take out the accounts if Israel is going to provide their names. But the tax authorities did not agree for it. We'll wait to see what will happen in the Knesset. Before I'm coming to the FATCA, there is this new proposed legislation will allow for another important things that the world is going in this direction as well. In addition to automatic exchange of information, there are new treaties for help in administrative help between tax authorities. Meaning today, for example, if tax authorities find out that a U.S. resident did not pay his taxes in Israel and he has no assets in Israel, they cannot ask the U.S. authorities to go after him in the U.S. and to collect the money for the Israeli authorities, and vice versa. The Israeli authorities do not collect taxes for other authorities. There are currently, the OECD is now working on new treaties, and probably Israel will join at certain point, which will facilitate this administrative help, meaning that the tax authorities in one country will provide administrative help for the tax authorities in other countries, will help to collect and will help to collect taxes for each other. So this is another direction that this new legislation will allow for. Now, one very significant part of the exchange of information is the FATCA. As was described before, the FATCA is a very crucial element, and in Israel it was taken very seriously. In the last years, there were a few steps that were taken in order to enable the implementation of FATCA in Israel. First of all, at the beginning of the year, the supervisor of the bank in Bank of Israel actually instructed all the banks to be prepared for FATCA. He asked them to put, it's not a very detailed order, but in essence it asks them to put teams in each bank that will be responsible for the enforcement of the FATCA. And he also determined, which is more important, that a refusal to provide services to a client because he does not cooperate with the FATCA will not be considered it's actually something that the bank can do, meaning that the bank can refuse to provide services to a client that does not wish to comply with FATCA, which is a very important determination of the supervisor. After the supervisor order, the government introduced a new legislation that will enable the government, or actually the tax authorities, to publish regulations that will enforce the bank to collect the information under the FATCA. This was published in April 2014. However, again, until now, I didn't see any progress with it. It was not yet introduced to the Knesset, but it exists. Probably one day, no one knows when it will happen, but one day it will come to the Knesset and will become a law. The regulations themselves have not yet been published, and there is no draft of there is even no draft of regulations. So in essence, the government is moving, but it's not moving very quickly. So I don't know, and no one knows when all this process will finish. But when it will be finished, then as was stated here before, Israel was also signed on June 30, 2014. It signed an agreement with the United States, according to the Model 1 IGA, Intergovernmental Agreement, according to which the Israeli banks will be required to provide information to the tax authorities in Israel, and the tax authorities in Israel will provide information to the US. When it will be effective, it's a big question. Probably it is already effective with for accounts that were opened after June 30, 2014, meaning that current account will already probably be reported under this agreement. Although currently there is no legislation that enables the transfer of the information, but once it will happen, once there will be legislation, probably it will be retroactive for the end of July. So this is with respect to the FATCA. Now, how Israelis can be prepared for this exchange of information that will probably happen in the next few years. There are actually three ways to do it. I'm talking about only on the legal ways, of course. There are a few settlements that are proposed by the tax authorities. The one is that Yair spoke about before is the voluntary disclosure. I'll not get into the details, but you may ask yourself why now, when the information is going to come to tax authorities, why tax authorities are now volunteer to allow people to come forward? They are going to catch them in a few years, so why they are letting people to come forward? It's a legitimate question. I think that the tax authorities understood, and if you will look on most of the account holders in Switzerland, are quite normative people. It's not the big tax evaders. It's not the people that you think that will be criminals. It's really normative people that, for reasons usually not for taxes, because they wish to have some money for rainy day, or they wish to have an account that no one will know about. They will not so care about taxes, so they keep an account in Switzerland. Some of them didn't know that they have to report it. So the tax authorities understand the situation, and they allow these people now to come forward. In addition to that, I believe there is an understanding with the tax authorities that if they will not let people to come forward now, people will find other solutions, and the money will go away again for a very long period from the Israeli system. So I think the government understood that it's in the interest of the government to encourage these people now to come forward, to declare the money, and to enter this money into the Israeli economy, and not to leave them in another solution for the next 50 years as well. So generally, the tax authorities, or I think the new voluntary disclosure is very attractive. The tax authorities wish people to come, and they are not hostile. It's not that they're very. I'll not say that they're friendly, but definitely they're not hostile, and they encourage people to come forward. And how much will it cost you? This is the big question. How much? When the client comes, so we wish to understand how much will it cost him. So the new voluntary disclosure is not an amnesty. There is no reduction of the tax liability. Taxpayers are required to pay the full tax liability for the last 10 years, from 2004 to 2013. However, if you will make a calculation of most of the portfolios during these years did not do very well. There was the crash in 2008, and then there were a lot of losses. So if you will make the calculation for the last 10 years, you will find out usually that the payment here is not so high. Usually it's around 5 or 6% from the amount of the portfolio. Again, it depends. There are some that did better, some that did worse, but generally it's 5 to 6% from the portfolio. So it's not a lot of money. And there is another payment, and this is what we call the tax on principle. An individual now comes for the beginning of 2004, and he comes with $10 million for the beginning of 2004, and usually he know how to explain it, but he have no proofs. And the unfortunate problem is that both people that have a good explanation and the ones that don't have a good explanations are coming with the same explanations. So tax authorities do not believe anyone, and they say that the burden of proof is on the individual, which makes sense. And usually people cannot prove anything 10 years ago because banks destroyed all the information, and there is no way to prove where the money came from or what happened in the account before 2004. And that's why most of the taxpayers find themselves have to pay or have to pay some tax on the principal. And what is the idea of paying tax on the principal? The idea is that follows. Tax authority says that if you did not pay the applicable taxes, there is no statute of limitation, meaning that they can collect taxes even from 50 years ago, because there is no statute of limitation. And by the way, it's not completely ridiculous. It's under the wording of the law. There is indeed no statute of limitation. There is, by the way, a new law from a month ago with respect to national insurance, Social Security, that specifically said that in the case of non-reporting, there is no statute of limitation. So currently it's also codified with respect to national insurance, but this is the customary position of the tax authorities for many years. So they say there is no statute of limitation. You can now not prove what was the income in the account for the last 50 years or since you opened the account. So you will have to pay us, or we will assess how much tax you should have paid us. And this, how the way it is being done is by imposing tax on the principal, on the amount that you had in 2004 in the account. Usually the percentages are flexible. It depends on the case, and it depends on the, unfortunately, it depends on the local office you deal with. Currently, the tax authorities are trying to make something more unified. They appointed 2 people from the headquarters of the tax authority, 2 officers, Mr. Amir Davidov and Mr. Avishai Diner, 2 people from the headquarters that are going between the offices. And they try to make something more unified. Usually, from our experience, the tax on principal is ranging between 6 to, let's say, in the worst cases, 20%. So it's not the end of the world. Most of the cases, it's around 10%, and it's around 10% without interest from 2004 and according to the current exchange rate. So it's not the end of the world. If you look at the overall package, I believe that the overall package is quite attractive. And although it may seem very, very scary that there is no statute of limitation and they can collect taxes 50 years ago, at the end of the day, if you look on the Israeli result is much better than the results that you achieve in countries that have statute of limitation. For example, in the US, there is a statute of limitation, you end up paying more than 50% of the account. In Israel, it's usually up to 20%, so it's really not the end of the world. And people usually don't have to be scared from it. With one caveat, of course, if there is fresh money in the accounts, meaning that there were deposits in the last 10 years, or there was undeclared income in the last 10 years, this is of course subject to the regular 50% tax. But all deposit or respect to old money, there are quite good rules or quite good practice. There are no rules, so nothing was published about it. By the way, it's all a common practice. With respect to people that held their asset in a trust, there is a similar arrangement, which is more defined. And here you usually pay 10% tax on the principal. It's very similar to the voluntary disclosure. It's not criminal, by the way. It's completely not criminal. A trust arrangement you can do in completely civil way without any criminal effect. And you usually pay, again, 10% on the principal and the full tax from 2003 to 2014, again, without any criminal implication. There is also a new settlement for trusts that were settled by a foreign resident. If At will elaborate on it, so I'll not get into it. But very generally, if you had an uncle that instead of inherit for you money and put it in a bank account, he created a trust for your benefit, then you are in a much better situation, and you can end up paying only 3% of the 3% of the trust value today and clean up everything. It usually will be between 3 to 6%, which is very, very advantageous. So this is it's a very new procedure, and it's very advantageous. Again, it will not apply to all cases, only for trusts that were settled by foreign residents. And probably, by the way, there will be a fourth way to settle. There is probably going to be a special settlement for diamond dealers. Diamond dealers in Israel are very, very unique, and the tax it's a very unique and very important industry in Israel. So they are probably going to have a special arrangement for them. It is currently negotiated. It was not yet published. Not yet clear what will get out of it. But currently, tax authorities are working on a special arrangement for diamond dealers as well. Okay, so the next thing I will touch is two important case laws on residency for the people of you who wish to relocate or go back to the US. There were two very important cases one of the Supreme Court, one of the District Court. The first thing is regarding the question whether married couple can have different residency, meaning whether when you have a married couple, husband and a wife, there can be a situation that the wife and the family are living in Israel and are Israeli resident, and the husband is living abroad and is not an Israeli resident. For many years, the tax authorities took the position that this is impossible. If the family lives in Israel, then all the family is an Israeli resident, including the husband that is living abroad. Now there was a recent case which was confirmed by the Supreme Court, the Michal Sapir case. It is a case where the family lived in Israel, the wife and the children lived in Israel, and the husband lived in Singapore. And both the district court and the Supreme Court held that it is possible that the husband that is living in Singapore will not be considered as Israeli resident and therefore will not be subject to tax in Israel. Even more than that, the case law does not say it, but it comes from this case law that this individual or this father, that the husband can live outside Israel for 10 years. After 10 years, he can come back to Israel, and then he have a 10-year exemption again. So we can. So it's a very unique regime. Tax authorities said at the time that they are going to change the legislation to prevent this result. Currently, there was no change or no suggested change. I'll skip the AK, which is not so important. The other important case is the Tzur case, which was published a couple of weeks ago. In this case, again, the customary position of the tax authorities was that if an individual leaves Israel for a short period, usually it was less than 3 or 4 years, he remains an Israeli resident. I'll not get into the justification, but here there was a case of relocation to Hong Kong. Ms. Tzur went to work in Tsim, in the shipment company Tsim, in Tsim, Hong Kong, and she went there only to 2.5 years. And here the court says that despite the fact that she went for only 2.5 years, she ceased being an Israeli resident and she became a resident of Hong Kong. And by the way, Hong Kong is a country with which Israel has no tax treaty. The tax treaty with China does not apply to Hong Kong. So this is the case that only according to domestic law, the district court ruled that an individual can leave Israel for a short period and cease being an Israeli resident. It's a very important decision that was published only a couple of weeks ago. By the law, the law was changed, and for some reason, I don't know why, the district court decisions do not refer to it. Now there is a very specific determination in the ordinance that says that in order to cease being an Israeli resident, you have to leave Israel for at least 4 years. In the first 2 years, you have to be less than 183 days, and in the third and the fourth year, you have to show that the center of your life is outside Israel. This applies from 2007, and although the Tzur case refers to the years of 2006 and 2007, for some reason it does not refer to this amendment. But today the law is quite clear. In order to cease being an Israeli resident, you have to live for at least 4 years. Okay, I'll skip the cases regarding management control, which are also important. And I just want to bring to your attention few expected changes in the legislation that are going to expand the requirement of Israelis to report or to submit returns. As you're probably aware, in Israel, most of the population, more than 90% of the population, do not submit annual tax returns. Israel works under a regime of withholding. There is a very strong regime of withholding, and most of the population do not submit tax returns. Now, the tax authorities are currently trying to expand the net of people that are required to report in Israel, and they are doing it in several ways. Recently, they sent 100,000 forms to Israeli residents, and probably they will ask them to open tax files. In addition, they made certain changes in the legislation. One of the changes will require any Israeli resident who is a beneficiary of a trust, who is over the age of 25, to submit a tax return, unless you do not know that he's a beneficiary. I don't know how anyone can prove if he knows or don't know that he's a beneficiary. Probably if he receives money from the trust, he knows that he's a beneficiary. So this will enter into the net a lot of people. In addition for that, it's not written here, anyone who transfers more than 500,000 shekels abroad will be required to submit tax returns. Anyone, if you purchase real property outside Israel, never mind why you transfer the money. If you transfer more than 500,000 shekel outside Israel, you will be required to submit return and to report your worldwide income. Another change is that currently there are a lot of people in Israel that are living a lot of days in Israel, and they are taking a legal position or taking a legal opinion that they are not Israeli residents because the center of their life is not in Israel. The taxes, and there are a few absurd cases of people that are living in Israel 2/3 of the year, 250 days, and are arguing that they are not Israeli residents, and tax authorities could not catch them. So in order to fight with this phenomena, the tax authorities propose now to change the legislation. Everything is in the next budget that will be confirmed in the next month. So the tax authorities are going to change the law to determine that anyone with respect to which the day's presumption is met will have to submit tax return. And what is day presumption? It means generally that if he stays in Israel more than half a year or more than 425 days on a 3-year period. So any person that stays in Israel more than 183 days or 425 days over a 3-year period will be required to submit annual tax return. And one last thing, and the last change, it was already done. Tax authorities changed the regulations which requires reporting from Israelis, and now any Israeli who trade in securities, who has sales of securities of more than 800,000 shekels a year, which is not a lot of money because it's the turnover. It refers to the turnover, not to the gain. If you have a turnover of more than 800,000 shekels, you have to submit tax return. Unfortunately, most of the population don't know about it because anyone who has a portfolio of 1 million shekels and roll it over twice during the year will have to submit tax return. So I think the way it is being done is not proper because now many people are going to be criminals and they're not going to submit tax returns simply because they don't know about this provision. But again, these are the new rules, and from now on, much more people are expected to be required to submit tax returns in Israel, which is, I believe, a happy news for the ones of you who are accountants here. So I'll end with this good news for you. Thank you.